Welcome back to the deep dive. Today, we're really cracking open the vault on a big one. KKR Co. Inc., one of the absolute titans of the alternative asset world. We've pulled together quite a stack of recent, really in-depth investment analysis sources, all focused on KKR. And let me tell you, this isn't like a history lesson, not just barbarians at the gate stuff. This is about understanding their dramatic strategic pivot right now, how they're fundamentally changing, well, the mechanics of how they make money.
That's exactly it, yeah.
Yeah.
Our mission here, really, for you, the listener, it's to get why you can't just call KKR a private equity firm anymore. It's more complex now. We're going to dissect KKR as this transforming hybrid entity, one that's purposefully migrating really toward a structurally more stable, more predictable revenue model. The story here is that shift away from the ups and downs, the episodic nature of LBOs, towards the compounding power of what they call perpetual capital.
Okay, so let's unpack that transformation, but maybe starting with that powerful legacy. KKR, of course, Kohlberg, Kravis, Roberts, founded way back 1976. Henry Kravis, George Roberts, Jerome Kohlberg. These guys didn't just do LBOs.
No, they practically invented it. They pioneered the whole leveraged buyout industry, defined an era of finance, really.
Absolutely. But while that legacy, it gives them incredible brand recognition, maybe helps with deal flow, you have to look at the scale today. That's what defines their modern identity, right?
Totally. KKR now is a premier global investment firm, operations spanning North America, Europe, Asia. It's everywhere.
Yeah.
They manage assets for the really sophisticated players, pension funds, sovereign wealth funds, but also, and this is like the critical structural change we need to dig into, they are aggressively targeting individual investors now. It's this whole, democratization of private markets idea.
And the numbers, well, they confirm the sheer magnitude of this operation. As of the second quarter of 2025, KKR's total assets under management AUM stood at, what was it, $686 billion.
$686 billion, just an enormous amount of capital. But maybe even more telling than the current number is the target they've set.
Yeah, the big goal.
Reaching $1 trillion in AUM by 2030. Now, when a firm that size sets a goal like that, it signals a huge mandate, a multi-year push for aggressive structural growth. It means they need deep penetration into new markets, new asset classes. They can't just rely on the old fundraising cycles.
Right. So management is basically saying we have to transform to hit this number.
Exactly. That's the company we're analyzing today, one that's doubling down on transformation.
Okay, so that ambition, it's really underpinned by this major recent change, the 2024 business resegmentation. And you mentioned this wasn't just like shuffling deck chairs for the quarterly report.
Not at all. This was management formally recognizing how their core engines actually make money now. It reflects the reality of the business. Before 2024, the identity, maybe it was a little murky, a bit harder to parse. Now, KKR organizes itself around three really distinct, formalized pillars. And these pillars, they define that hybrid identity we talked about.
Okay, what are the three?
So first, you've got asset management. This is the traditional core,
Mm-hmm.
the engine managing third-party capital. Across private equity, credit, infrastructure, real estate, all the usual suspects.
Yeah.
And this generates those reliable, recurring management fees. That's the stable bedrock, right? The predictable part.
Got it. Pillar one, traditional asset management fees.
Pillar two, insurance. This is the operations of Global Atlantic Financial Group. KKR fully acquired them in January 2024. And this isn't just like a side business. It's seen as a strategic asset.
Strategic how? Because it throws off cash.
Well, yes, but more, because it provides KKR with this massive, dedicated, long-duration capital base. It comes from policyholder premiums. Think about it. Insurance liabilities are inherently long-term.
Mm-hmm.
So Global Atlantic gives KKR this huge internal source of permanent AUM, stable money.
Okay, that makes sense. A captive pool of long-term capital. And then the third pillar, the really new one.
Yes, the one that really kind of separates them. Strategic holdings.
Strategic holdings. What exactly is that?
This segment is basically KKR's own money, their own substantial participation in their core strategies. It's funded directly by their corporate balance sheet, the firm's skin in the game, you could call it.
So the money they invest alongside their clients.
Exactly. And that amount has become so material, so large, that management now evaluates it as a distinct business line. We're talking about roughly $28.6 billion invested in or committed to its own funds as of year-end 2024.
Wow. Okay, nearly $30 billion of their own capital in these funds. Doesn't that structurally make them, I don't know, less agile, a bit more like a capital-intensive bank than a pure fee-collecting asset manager?
That's a really crucial question. And you can see how it might look that way. But they mitigate that sort of bank-like structure through active management. And arguably, it makes them more agile in one specific, very important way.
How so?
Well, think about launching a new strategy, say a new infrastructure debt fund. Most firms, they'd have to spend months, maybe years, out fundraising from LPs before they could even start investing.
Right, the traditional roadshow.
KKR, with that nearly $30 billion balance sheet, they can use that as a massive internal first client. They can seed and scale new strategies internally, prove out the concept, build immediate scale before they even go to external LPs.
Ah, okay, so it speeds things up dramatically.
Exactly. It dramatically accelerates the product development cycle. And it shows external investors, look, we believe in this so much, we put billions of our own money in first. That builds confidence.
So, okay, this is where that hybrid entity term really clicks into place. Part asset manager, earning fees on client money, and part massive investment holding company, compounding its own wealth.
You got it. That's like layering a Berkshire Hathaway-style compounder right on top of the traditional asset management business. And the structure is kind of cemented by these internal fee arrangements.
Internal fees between the segments.
Yeah, between the asset management segment and the strategic holdings segment. KKR's corporate capital, the strategic holdings part, benefits from the investment engine. And the asset management side, it gets to charge management and potentially performance fees on that corporate capital.
Okay. So it's like they're their own client in a way.
It creates this self-reinforcing symbiotic ecosystem. It's quite clever, actually.
Okay, so zooming out then. We have this structure. How does it all translate into actual revenue? How does KKR make money? We sort of distilled it down to 4 core ways, right?
Yeah, 4 main dynamics powering this structure. Let's run through them. 1, management fees, FRE, we touched on this. Stable, recurring fees, usually a percentage of AUM or committed capital. This is the bedrock of predictability. Provides that strong floor for what they call fee-related earnings, or FRE. Very important metric.
Okay, stable management fees, number 1.
2, performance fees, also known as carried interest, or carry. This is the classic private equity upside. It's volatile, it's incentive-based, usually that 20% share of profits above a certain hurdle. But, crucially, it's only recognized when they successfully sell investments, when they have exits.
Right. So high margin, potentially huge upside, but totally depends on the M&A or IPO markets being open. Very cyclical.
Very cyclical. That's the key drawback they're trying to balance out. 3, investment income. This is the direct return KKR generates from investing its own capital. You know, that $28.6 billion balance sheet we mentioned, the profit from those investments flows through here.
So this is the skin in the game payoff. It aligns them directly with their LPs.
Exactly. Critical alignment. They win when their clients win. And finally, number 4, capital markets fees. KKR has its own capital markets division. It earns transaction fees, advisory fees, monitoring fees.
Like an internal investment bank.
Pretty much. They provide financing solutions, debt underwriting, equity underwriting, syndication mainly to their portfolio companies, but also some third-party clients. It supports the primary investment activities, helps get deals done, helps refinance portfolio companies. It's another part of that ecosystem.
Okay, so that structural shift, those 4 revenue streams, it all leads directly into KKR's main strategic pivot. Moving away from that volatile sort of rinse and repeat cycle of traditional fundraising towards this idea of perpetual capital.
Yes. This is arguably the absolute core of the whole long-term investment thesis for KKR right now. Perpetual capital, basically. It means long-duration investment vehicles, ones that don't have a set end date, no predetermined liquidation date.
Unlike, say, a traditional 10-year private equity fund that has to eventually sell everything and return the money.
Exactly. Traditional funds wind down. That forces the firm to go out and raise a successor fund. It's a constant cycle. Perpetual vehicles, though, they hold capital and can reinvest it indefinitely, or at least for very long periods. And for KKR, this offers a structurally stable, predictable stream of management fees. Fees that, in theory, never turn off.
And the data, it shows this isn't just talk. This shift is happening fast. Perpetual capital grew, 16% year over year in Q2 2025, reached $289 billion.
Huge growth. But here's the kicker, the key insight for listeners. Perpetual capital now accounts for 50%, half of their fee-paying AUM, the assets they actually earn fees on. But it's only 42% of their total AUM.
Okay, wait. 50% of fee-paying AUM, but only 42% of total AUM. What does that gap tell us?
That disparity is incredibly important when you're analyzing the finances. It tells you that these long-duration perpetual capital vehicles are, on average, more fee-efficient for KKR.
Meaning they earn more fees per dollar managed compared to the older traditional funds.
Exactly. They generate a higher percentage of fee revenue per dollar of assets. And this fundamentally improves the quality, the predictability, the durability of KKR's overall fee-related earnings base. That's the stability the market loves and rewards with a premium valuation.
Got it. So better quality earnings, more stable, that's the goal. So if perpetual capital is the target, what are the main engines driving this growth? You mentioned two big ones.
Yeah, two primary drivers. The first is Global Atlantic, that big insurance acquisition we talked about.
Right, the one they fully bought in 2024.
That was pivotal because the insurer provides this massive, captive, permanent capital source. It comes from the policyholder premiums. Insurance liabilities, as we said, they're long-term, highly predictable. That capital needs stable, usually investment-grade, long-duration assets to back it.
Making Global Atlantic the perfect internal client for KKR's investment platforms.
An ideal, guaranteed anchor client, yes.
And having a captive balance sheet that large, it must allow KKR to seed and scale new strategies with immediate confidence.
Absolutely. Think about the trust it instills in external investors, too.
Yeah.
The sources we looked at highlighted this $2 billion IV sidecar deal with Japan Post Insurance.
Okay.
This is capital that's expected to drive something like $60 billion in incremental fee-paying AUM for Global Atlantic once it's fully deployed. This is basically KKR using its internal structure, its scale, to dictate strategic asset allocation on a massive, almost unprecedented level. It really cements that relationship between the asset management pillar and the insurance pillar.
Wow. 60 billion incremental FPAUM from one deal. That's a huge strategic advantage, having that guaranteed client ready for new strategies. Okay, so Global Atlantic is driver number one. What's the second, maybe more ambitious one?
The second, and arguably the area with the highest potential growth, is private wealth. They're aggressively marketing this through their K-Series products.
Tri-Series.
Yeah. This is KKR targeting individual investors.
Yeah.
High net worth individuals, family offices, tapping into what they estimate is a $190 trillion addressable market.
190 trillion. That's astronomical.
It is. And it confirms that this idea, the democratization of private markets, isn't just a little trend. It's arguably the industry's central growth mandate for the next decade, bringing private assets to non-institutional investors.
And how are they doing it with these K-Series products?
Exactly. They're offering products like PayPrime for private equity, Crest for real estate. And the structure here is really key. These are set up as evergreen or semi-liquid funds.
Evergreen, semi-liquid. What does that mean practically?
It means they allow continuous subscriptions. Investors can put money in, often monthly or quarterly. And there are typically limited options for investors to take money out, hence semi-liquid. It avoids that cumbersome traditional capital call model where you commit money but then wait years for it to actually be drawn down and invested. It's much more user-friendly for individuals.
Okay, easier access, continuous flow. Is it working?
The platform is moving incredibly fast. K-Series AUM doubled year over year, hit $25 billion as of Q2 2025. And management's goal here really shows how serious this pivot is. They want this private wealth channel to grow from maybe 15% of new capital inflows today to as much as 50% over time.
Wow. Half of all new money coming from individuals eventually? That's a fundamental reshaping of their client base?
It really is a massive strategic shift. #TagAV, industry headwinds, tailwinds, and competitive positioning. Now, to really understand KKR's path, you got to place them in the current macro environment, right? The whole alternative asset industry is still adapting to this post-ZIRP world.
ZIRP is zero interest rate policy, the end of basically free money.
Right. And the reality of structurally higher interest rates now, maybe not high by historical standards, but higher than zero. And that fundamental shift, it just changed the whole calculation for leverage valuations, for financing, almost overnight.
And the impact wasn't uniform, was it? It created winners and losers, even within KKR's own different strategies.
Absolutely. Big divergence. Take private equity.
Yeah.
Higher leverage costs directly compress potential returns. LBOs rely heavily on cheap debt. When debt gets expensive, the math just gets much harder to hit those target returns.
So deal-making slowed down.
Yeah, it definitely put the brakes on things for a while, but conditions have started to ease up a bit recently. The sources we saw noted that the U.S. Fed lowered its target rate down to, 4.25, 4.50% by December 2024. That made financing a bit more favorable. And it's signaling a potential M&A rebound in 2025.
Which is crucial for KKR because M&A and IPOs are how they realize those big performance fees from private equity exits.
Exactly. That potential rebound is key for unlocking that coiled spring of carry.
Okay, so PE faced headwinds but might be improving. Meanwhile, their private credit platform, That was a different story.
Oh, yeah. Private credit was enjoying a massive economic tailwind from the rate hikes, a huge beneficiary. Most private credit loans are floating rate eights. So as base rates went up, the returns paid to the lenders like KKR went up too.
Ah, automatic profit boost.
Pretty much. They were delivering really attractive returns, high single, low double digits, precisely when other asset classes were struggling. And crucially, you had this backdrop of banks pulling back.
Because of regulation. Post-2008 rules?
Largely, yes.
Yeah.
Increased capital requirements, more scrutiny. Banks retreated from certain types of riskier lending. That created this huge vacuum, this market opportunity that non-bank lenders like KKR were perfectly positioned to step into and fill. Massive growth for private credit.
Okay, speaking of vacuums, the fundraising environment itself, it's been notoriously difficult lately, hasn't it? The denominator effect.
Yeah, that's been a big theme, the denominator effect.
Yeah.
Basically, public market portfolios, like stocks and bonds, fell sharply in value. That meant that an institution's allocation to illiquid private assets, like private equity, suddenly looked too large as a percentage of their total portfolio, even if they hadn't invested any new money.
Because the total portfolio value shrank.
Exactly. So that constrained their ability or willingness to make new commitments to private funds. Budgets got tight.
So a tough time to raise money overall. But how did that impact a giant like KKR?
Well, interestingly, this challenging environment actually became a tailwind for the biggest players. Limited partners, the LPs, they didn't just stop allocating completely, but they became much more selective. They initiated this decisive flight to quality.
Meaning they stuck with the names they knew and trusted.
Precisely. They concentrated their limited new capital with the largest, most established multi-strategy managers, firms like KKR, Blackstone, Apollo. This effectively starved smaller, newer, or more niche competitors of capital. So ironically, the tough market reinforced KKR's competitive strength and helped drive market share consolidation across the industry.
That really shows the power of scale and brand, and it seems to be working for them based on their dry powder. They have, what, $115 billion in uncalled capital ready to go as of Q2 25?
Yep, $115 billion, a huge war chest.
Now, I have to ask, is that massive pile of dry powder purely a strength? Or could it also be a sign they're actually struggling to find deals they like at current prices? Is it money sitting idle?
That's a really thoughtful question. It's definitely a double-edged sword, especially in a shifting rate environment. On one hand, it's a massive competitive advantage. It allows KKR to be patient, to act countercyclically, to seize opportunities when weaker players are forced to pull back or sell.
Right, the ability to buy when others have to sell.
Exactly. But on the other hand, holding large amounts of committed capital that isn't deployed yet, well, you're not earning management fees on it, generally. And obviously, it isn't generating investment returns yet, so there's pressure to deploy it. The sources suggest management views it mostly as strategic optionality right now. They're waiting for valuations, especially in private equity, to maybe normalize a bit more, waiting for more certainty in the capital markets before really unleashing that war chest.
Positioning for that M&A rebound you mentioned earlier.
Exactly. It puts them in a great spot if and when that happens.
Okay, let's quickly touch on their core competitive moats. What allows them to attract all that capital, even in a tough market, beyond just size?
Yeah, there are three clear ones that stand out. First, brand and track record. We talked about the legacy. KKR is basically synonymous with private equity. That reputation attracts proprietary deal flow deals that other firms might not even see. And it attracts capital. Yeah, they recently topped the PEI 300 ranking for capital raised over the last 5 years. That just underscores their dominance.
Okay, burn power, number one.
Second, global scale. They have this extensive network, 37 offices around the world. This isn't just dots on a map. It allows them to source, diligence, and execute incredibly complex cross-border deals. Deals that smaller regional firms simply couldn't handle due to geographical reach or regulatory complexity.
Global reach enables complex deals. Got it.
And third, what they call the One KKR ecosystem. This is about their collaborative culture, but also their operational capabilities. They leverage KKR Capstone. That's their dedicated internal team of operational experts, former CEOs, consultants.
The people who actually go into the portfolio companies and help run them better.
Exactly. They help improve efficiency, strategy, operations, and they leverage their internal capital markets team, which we discussed. The point is, KKR doesn't just buy a company and slap on leverage. They buy it, actively work to improve it operationally, finance it strategically using their internal bank, and then engineer an exit.
So it's post-acquisition value creation, not just financial engineering.
Right. That really differentiates them from sponsors who are purely financial players.
Yeah.
It's a key part of their pitch and their track record.
Okay, so if perpetual capital is the overall strategy, the engine room, let's look closer at the specific fuel sources. The asset class is really driving future fee growth.
Yeah, two sectors really stand out as key growth engines right now. First, KKR's credit platform. It's already massive, $292 billion in AUM, huge scale. And within that, they're making this really significant push into something called asset-based finance, or ABF.
Okay, ABF. Explain that because it sounds different from the typical corporate direct lending everyone talks about, like lending to mid-market companies based on their earnings.
It is different, very different. Traditional private credit, like you said, usually lends against a company's cash flows. It's EBITDA, basically. ABF, on the other hand, is lending against hard, tangible assets or sometimes contractual cash flows. Think about things like pools of aircraft leases, portfolios of auto loans, equipment leases, maybe even royalty streams or trade receivables.
Okay, so lending backed by specific, often physical collateral, not just the general health of the company.
Exactly. These loans are often seen as higher quality because they have that direct collateral backing. They tend to be lower volatility than corporate lending, especially during downturns. And KKR sees a massive opportunity here. They estimate the addressable market for ABF could expand from around $6 trillion today to potentially $9 trillion over the next 4 years.
Why such huge growth? Is it banks pulling back again?
That's a big part of it. Banks continue to de-risk their balance sheets, moving away from holding these types of complex, specialized assets. That creates an opening for firms like KKR. And KKR is already making major inroads. Their own ABF AUM has hit $75 billion, growing at 20% year over year. It's a huge focus area.
Okay, so ABF is a major growth engine within credit. What's the other key driver you mentioned?
The other one, tied to these enormous global shifts, is infrastructure. KKR launched their infrastructure platform back in 2008, so they've been at it a while. It's now about $90 billion in AUM. And its future growth seems almost guaranteed because it's tethered to these global mega trends that require just immense capital investment, far more than governments alone can provide.
Mega trends, like what specifically?
Well, we're talking about three specific, almost tectonic shifts happening globally. First, digitalization, everything moving online, AI, cloud computing. This requires just staggering investment in data centers, fiber optic networks, communication towers.
The physical backbone of the digital world.
Exactly. Second, the energy transition and decarbonization. Moving away from fossil fuels, modernizing electrical grids, building massive amounts of renewable power generation, solar, wind, batteries. Huge capital needed there. And third, something maybe less talked about but equally important, deglobalization or maybe reglobalization.
You mean like reshoring supply chains, bringing manufacturing back?
Yeah, reshoring supply chains, building new resilient factories closer to home, modernizing ports and logistics infrastructure to handle shifting trade patterns. All of that requires enormous capital deployment. KKR is positioning itself to be a core capital provider for all three of these necessary structural upgrades across the globe.
Okay, ABF and infrastructure, two big growth areas. Here's where it gets really interesting, I think. Connecting these pieces. You talked about this virtuous flywheel concept, how it's not just separate businesses, but an integrated ecosystem.
Yes. This is like the strategic genius of the whole transformation, potentially. And it really centers on Global Atlantic, the insurance arm.
Okay, bring it together. How does GA fit with ABF and infra?
Well, think back to GA's liabilities, the promises it makes to policyholders. Those are long-term, stable, predictable promises. So the assets KKR needs to invest GA's capital into must also be stable, long duration, predictable, and generally high quality, often investment grade.
Okay.
Now think about asset-based finance. Those loans backed by hard assets, structured contractual cash flows. What characteristics do they have?
Stable, long duration, predictable cash flows, often collateralized, so higher quality.
Exactly. ABF assets are an almost perfect match for the liability profile of an insurance company like Global Atlantic.
So Global Atlantic becomes this massive, captive, built-in anchor client for KKR's own ABF platform.
Precisely. It gives the ABF platform guaranteed, instant scale, a massive, predictable stream of demand for the ABF assets KKR originates or acquires.
That's huge. It must lower their cost of capital for ABF strategies, too.
Dramatically. It allows KKR to manufacture these specialized ABF products at immense institutional scale, probably much cheaper than competitors without a captive insurer. And then here's the flywheel part. This institutional success, this scale, allows KKR to productize ABF. They can package it up into funds, like the KABF fund mentioned in the sources, and offer it not just to other institutions, but crucially, back to that private wealth channel, the individual investors.
So the scale from GA enables products for retail. Wow.
Exactly. And the management fees flow back to KKR's asset management segment from Global Atlantic internally, from the third-party institutions buying the funds, and from the retail investors in the K-Series ABF products. It creates this self-reinforcing cycle. Lower cost origination, captive demand, productization, wider distribution, generating more AUM growth and more stable fee income.
That is the integrated flywheel in full effect, cementing their competitive advantage. Okay, that makes a lot of sense.
It's the core synergy they're trying to exploit.
And underpinning all this, they're using operational advantages too, like proprietary tech. Sources mention something called Credit QB.
Yeah, Credit QB seems to be some kind of proprietary risk management or portfolio monitoring system for their massive credit platform. And they're clearly focused on tech and data. Just look at the strategic hires they're making.
Like the former AWS CEO.
Exactly. Appointing Adam Selipsky, the former CEO of Amazon Web Services, as a senior advisor specifically focused on AI strategy. That's highly telling. It signals that KKR gets it. In today's world, just having good deal flow isn't enough. You need to leverage AI, leverage data management, like using Credit QB to enhance risk modeling in that huge credit book. That's essential for optimizing returns, managing risk at scale, especially as they push more into those democratized retail-facing private markets. Technology becomes a key differentiator. #TagVI, financial performance, alignment, and risk factors.
Okay, let's shift gears a bit and talk numbers. Performance, stability, risk. When analysts look at these big alternative managers like KKR, why do they focus so much on non-GAAP metrics like fee-related earnings, FRE, instead of standard GAAP profit?
Yeah, that's a common point of confusion. It's because standard GAAP earnings for these firms are wildly volatile. They include mark-to-market changes in the value of the private investments they hold. These paper gains or losses can swing massively quarter to quarter based on market sentiment, discount rates, whatever. It doesn't reflect the actual cash coming in the door.
So GAAP profit isn't a great measure of the underlying business health.
Not for the stability aspect, no. What analysts and investors really care about for the long-term valuation is the sustainable, stable cash flow that doesn't rely on selling assets at potentially inflated marks. And that cash flow measure is fee-related earnings, FRE.
Okay, FRE. The core profitability of the asset management business before you factor in those lumpy performance fees.
Exactly. And KKR's FRE has been looking really strong. They reported a record FRE $0.98 per share in Q2 2025, driven by, I think it was an 18% increase in management fees year over year. That's a direct result of that perpetual capital strategy kicking in. More stable AUM generating more stable fees.
And crucially, that stability seems to be getting more efficient, the FRE margin. How much of that fee revenue KKR actually keeps as profit?
That expanded, right?
Yeah, it expanded to 69% on a trailing 12-month basis,
Okay.
which is a very healthy margin.
69% FRE margin. When you see that kind of operating leverage, that margin expansion, what does it tell you about their costs versus their AUM growth? Are they truly scaling efficiently?
That 69% margin and the fact that it's expanding is a critical signal of financial health and scalability.
It tells you KKR is successfully leveraging its fixed cost base, its offices, its technology platform, its core staff across a rapidly growing AUM base. As AUM grows, the incremental cost of managing each new dollar is relatively low compared to the incremental fee revenue it generates.
So more dollars fall to the bottom line as they get bigger.
Exactly. A high and expanding FRE margin suggests immense operating leverage. It means they can realistically chase that $1 trillion AUM goal without their administrative costs ballooning out of control proportionally. And that stability, that profitability, that scalability, that's why the market tends to give the FRE stream such a high valuation multiple compared to other parts of the business.
Okay, so FRE is the stable bedrock, getting stronger and more efficient. Then we have the other side of the coin, the exciting but unpredictable part, performance fees. You called it the coiled spring.
Yeah, exactly. This is the potential windfall, the big upside. While KKR actually realized, meaning got cash in hand, only about $2.6 billion in performance fees over the last 12 months, ending Q2 2025.
Which shows that exit market is maybe recovering, but slowly.
Right. It's picking up, but not booming yet.
Yeah.
But the embedded value, the potential future carry, is enormous. They have something like $252 billion of AUM that is eligible for performance fees, is currently valued above cost, and is actively accruing carry on paper.
Okay, $250 billion in AUM sitting there, potentially ready to generate huge fees if they can sell the underlying investments profitably.
Exactly. That quarter trillion figure represents the theoretical payday. But getting that cash depends entirely on a healthy, functioning exit market. You need robust M&A activity, open IPO windows, maybe a strong secondary market where they can sell stakes to other PE firms.
So the timing of realizing that cash is completely out of their direct control. It's totally sensitive to macroeconomic indicators, market sentiment, interest rates.
It is the primary source of earnings volatility that this whole new perpetual capital strategy is designed to mitigate and balance out over the long run. It's a massive future asset on the balance sheet, conceptually, but one whose timing is uncertain.
Got it. Okay, let's talk alignment. This seems like a real strength for KKR. The insider ownership is just phenomenal, isn't it? The co-founders, Henry Kravis and George Roberts, still hold enormous stakes. What were the numbers, like 9% each?
Yeah, around 9.13% for Kravis, worth about $9.8 billion, and 9.41% for Roberts, worth about $10.1 billion, based on recent data. Huge personal stakes.
$20 billion combined, roughly, tied up in KKR stock.
That kind of insider ownership is about as strong alignment with common shareholders as you can possibly get. Their personal fortunes are directly linked to the long-term appreciation of the stock price.
And that focus seems reinforced further down. The co-CEOs, Joseph Bay and Scott Nuttall, their compensation is heavily equity-weighted too.
Very much so. Big pay packages, yes, $73.1 million for Bay, $64.2 million for Nuttall reported, but a large chunk of that is typically in stock awards that vest over time, reinforcing that long-term focus. And crucially, KKR has pushed this ownership culture even further. It's not just the top brass.
How so?
They've actively facilitated equity awards or ownership stakes for nearly 170,000 non-senior management employees across their portfolio companies.
Wow. So workers at the companies KKR owns are getting equity.
Yeah, it's a program they've championed, trying to spread the benefits of ownership more broadly. It's a true widespread commitment to an ownership culture, top to bottom. Pretty unique at that scale.
That's a serious potential operational advantage, aligning everyone. Okay, but let's not paint too rosy a picture. We have to talk risks. What are the significant headwinds or risk factors here?
Absolutely. No investment is risk-free, especially one this complex. There are several key risks. First, the obvious one, that inherent macro dependence we've been discussing. Performance is highly sensitive to market volatility, shifts in credit spreads, inflation, interest rates, and of course the health of those crucial exit markets for realizing carry. A major downturn hurts them.
Okay, macro risk. What else?
Second, there's sector-specific stress. While KKR is diversified across many asset classes, they aren't immune to problems in specific areas. The most visible example recently has been in commercial real estate, CRE, particularly the office and retail segments.
Right. We saw that directly impact their related vehicle, KKR Real Estate Finance Trust, or KREF. Didn't it report a loss?
Yeah, KREF reported a GAAP net loss in a recent quarter after having to take ownership of a specific troubled property. I think it was a West Hollywood development. It just highlights that even a giant like KKR faces challenges when specific sectors, like CRE office, come under severe cyclical pressure.
A reminder that diversification helps, but doesn't eliminate all risk. Okay, what else?
Third, you always have regulatory scrutiny. Private markets, private equity, private credit, they're increasingly under the microscope from regulators globally. Concerns about transparency, fees, systemic risk. It's an ongoing theme.
And KKR has had recent run-ins.
Well, they settled with the SEC in January 2025, paid an $11.2 million penalty related to electronic communications record-keeping failures. Not core to their investment strategy, but shows the scrutiny. And as they push deeper into new areas, particularly that private wealth channel serving individuals, the regulatory complexity and compliance costs are only going to increase. That's a significant operational burden.
More regulation for retail products. Makes sense. Any other major risks?
The last one is probably key person risk. Although the succession from the founders to the co-CEOs Bay and Nuttall was executed smoothly a few years back, the eventual full departure of founders Kravis and Roberts, who were still co-executive chairmen, would still be a significant symbolic transition whenever it happens. They built the firm. Losing that founding presence is always a risk factor, even if operational control has passed. #7, valuation and the dual investment thesis. Okay, so all of this, the structure, the strategy, the performance, the risks, it brings us inevitably to valuation. How is the market pricing KKR right now? And because KKR is this hybrid entity we've described, part stable fee collector, part volatile carry generator, part balance sheet investor, valuing it is complex. You really can't just slap a single price to earnings multiple on the whole thing and call it a day.
Right. You need to break it down. Analysts use that sum of the parts approach, SOTP.
Exactly. SOTP is the standard way to think about it. You essentially value the different pieces separately based on their risk and growth profiles.
So, like, you put a premium multiple on the stable, predictable, fee-related earnings stream.
Right. Because that cash flow is seen as high quality, almost treasury-like in its stability, relatively speaking. It deserves a higher multiple.
Then you put a much lower, more discounted multiple on the volatile performance earnings, the carry.
Correct. Because the timing and realization of that cash flow are so uncertain and cyclical, lower multiple reflects higher risk.
And then you value the balance sheet assets, the strategic holdings piece, probably somewhere near book value.
Generally, yes.
Yeah.
Near or maybe slightly above tangible book value, depending on the analyst's view of the underlying investment. So you value each piece, add them up, and that gives you an SOTP estimate of the company's total value.
Okay. And when you do that kind of analysis, or just look at standard metrics, where does KKR trade? Is it cheap or expensive compared to peers?
Well, based on the analysis we reviewed, KKR currently trades at a price-to-book multiple of around 4.17x.
4.17 times book, how does that stack up?
It's a noticeable premium to most of its direct peers. For example, Carlyle was mentioned around 3.57x price-to-book, and even Apollo, which also has a big insurance arm with Athene, is around 4.00x.
Okay, so KKR gets a premium valuation compared to Carlyle and even Apollo. Why is that? Why does the market give KKR that edge over, say, Apollo, which has a very similar insurance plus asset management structure? Is it just the KKR brand name or something more structural?
It's likely a combination, but probably weighted more towards structural execution. The market seems to be pricing in a few specific things for KKR. First, the perceived exceptional quality, and importantly, the scalability of that FRE revenue stream. That 69% margin we talked about really stands out. It suggests superior operating leverage. Second, perhaps the market views the integration between KKR's asset management and Global Atlantic as particularly deep or synergistic. And third, maybe strong execution momentum on that critical private wealth channel growth initiative. The market seems to be rewarding KKR for successfully making that pivot towards perpetual, high-quality, fee-driven revenue streams, perhaps more convincingly than some peers, at least for now.
Okay, so the bottom line on valuation is KKR definitely trades at a premium. The market seems to be fully pricing in, maybe even anticipating, the success of this structural transformation, the perpetual capital shift, and a favorable cyclical rebound in investment exits.
That's a fair assessment. It sets a very high bar for the company to continue executing flawlessly. There's not much room for error priced in.
Okay, so let's synthesize all this. We can frame it as two competing investment narratives, right? The bull case versus the bear case.
Exactly. Let's lay them out. What's the core bull case for KKR?
All right, the bull case sees KKR as this high-quality, long-term compounder, a real best-in-class operator. It argues KKR captures market share during tough times like the recent fundraising drought, reinforcing its dominance. It's fundamentally de-risking its earnings profile by shifting from cyclical carry to stable FRE, powered by Global Atlantic and perpetual capital. The incredibly high insider alignment guarantees management stays focused on the long haul, not just quarterly bumps. And they're leveraging multiple powerful growth engines, private wealth, ABF, infrastructure to smash that $1 trillion AUM target and drive significant earnings growth. The bulls would say the market still hasn't fully appreciated the scale and quality of this fee transformation that's underway. There's more upside.
Okay, that's a compelling bull case. Strong execution, structural shift, high growth. Now, what about the counterargument, the bear case?
Right, the bear case starts with that premium valuation. It argues KKR is priced for perfection. Maybe the stock has run a bit ahead of the underlying fundamentals. Bears emphasize that KKR remains highly vulnerable to macroeconomic risks. If inflation stays sticky, rates stay high, or a recession hits, that could derail things. Specifically, if those exit markets, M&A, IPOs, fail to sustain their gradual recovery, or worse, freeze up again, that massive coiled spring of carry won't uncoil. Performance fees will disappoint. And maybe that ambitious private wealth strategy stumbles. Perhaps adoption by individuals is slower than hoped. Maybe regulatory costs prove higher. Or maybe they face real difficulty managing liquidity in those semi-liquid funds during a downturn. If any of that happens, the bears say the stock is vulnerable to a significant derating precisely because it trades at that premium multiple today.
So vulnerability to macro, execution risk in retail, and valuation risk.
Exactly. The short-term performance will always be somewhat tied to the timing of carry realizations. while the long-term thesis rests entirely on sustained growth in perpetual AUM and FRE, which isn't guaranteed, especially in the face of competition and potential market headwinds.
Well, this has been a fascinating deep dive. It really highlights KKR's incredible evolution over the decades. It's moved so far from being just that specialized LBO shop focused on big, cyclical deals to maybe becoming this scaled, diversified global asset manager that's fundamentally changing the very structure of how it earns fees. It's a remarkable transformation.
Yeah, absolutely. So the key takeaway, I think, for you, the listener, from all this, it's that the core value proposition of KKR is explicitly shifting. It's a conscious strategic move. They are moving away from primary reliance on those large, lumpy, cyclical deal wins that generate the volatile performance fees, and towards the stable, predictable, compounding power of permanent capital. Capital derived mainly from the global Atlantic insurance business and increasingly from that retail private wealth market. And that permanent capital is what drives the high quality, much more predictable fee-related earnings.
It's a business model transition that, frankly, every single one of their peers is desperately trying to emulate right now.
Yeah.
KKR just seems further along, perhaps, and there's also buddy. Every great opportunity usually holds an equally great or perhaps complex risk embedded within it.
Right, and that brings us to the final provocative thought we want to leave you mulling over. KKR's biggest single growth opportunity, that aggressive expansion into private wealth, selling to individuals via the K-Series funds, could also be its most complex, maybe even existential risk factor down the road.
Think about the fundamental shift in their client base. KKR is moving from dealing primarily with a few hundred highly sophisticated institutional investors, pension funds, endowments investors who fully understand illiquidity risk, lockups, capital calls, to potentially dealing with millions of individual investors who may have very different expectations about accessing their money. And they're accessing these inherently illiquid private assets, private equity, real estate, private credit, through funds structured to be semi-liquid.
That inherent liquidity mismatch, illiquid assets in a semi-liquid wrapper.
That's the crux of it.
Yeah.
So the central question, the provocation for you to consider is this. How will KKR successfully navigate and manage that inherent liquidity mismatch risk and the inevitably heightened regulatory scrutiny that comes with democratizing private markets during the next major financial downturn?
Yeah.
What happens if the market suddenly freezes up, panic sets in, and retail investors initiate widespread redemption requests from those K-Series funds all at once?
They'd likely have to enforce fund gates, restricting withdrawals.
Exactly. And KKR's ability to manage that process, enforcing gates, communicating clearly, handling potential mass redemption requests without suffering significant reputational damage or financial stress, that will likely be the central execution challenge. It might determine whether KKR can truly achieve that $1 trillion AUM goal smoothly without sacrificing the very stability and premium reputation they've worked so incredibly hard to build over these last few years. It's the tightrope they have to walk.